Welcome back, it's JWalter here. In today's video, I'm going to be sharing some news that mortgage rates have been spiking greatly. If you follow the channel, I talk about this all the time, but as of today, mortgage rates hit their highest levels since late 2018. I also want to share a new report regarding mortgage loan forbearance numbers in the US. So let's go ahead and dive right into the video. Also, if you get any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Also, consider subscribing if you haven't done so already. I post the latest housing market updates so you can make a more informed decision about whether you should buy or sell a house. So with that said, let's begin today's video. The first report I want to go over with you guys today is from the Mortgage News Daily. They actually just released this today at the time of this video, which is the 18th of April. They say the average 30-year fixed rate mortgage is averaging at 5.25% as of today. This is the highest levels since late 2018. There was one day last week where we also reached 5.25%, but we're still at very high levels historically speaking. In this report here, they basically said that nothing really happened in order to cause this. However, it's a simple matter of the mortgage market getting caught up with the movement in the bond market. So in other words, mortgage rates move more closely to the 10-year US Treasury yield, or the yield on the 10-year US Treasury note, and that has been increasing greatly. So that has reached its highest levels since late 2018 as well. And that's one reason why mortgage rates have been spiking. I'm going to be sharing some stats with you guys here in just a little bit. Meanwhile, inflation is running at its highest level since the 1980s, and the Fed has signaled they're going to be tightening their monetary policy in response to this. The Fed attempts to control inflation by raising short-term rates, that's the federal funds rate, and by shrinking its bond holdings. For its bond holdings, obviously it's going to be reducing its share of the mortgage-backed securities that it currently holds. So here's something I found to be very interesting, and also you should be aware of this as well. It says real-time markets have already done a great deal to move into position for these changes from the Fed. In other words, they mean real-time markets being the yield on the 10-year US Treasury note. So basically, they're saying that the Fed has already signaled they're going to be tightening their policy, they're going to be increasing the federal funds rate, and that's going to be causing, or has caused, mortgage rates to increase. So the yield on the 10-year US Treasury note has already moved in anticipation that the Fed is going to be doing this. It goes on to say traders will increasingly try to determine when enough of that positioning has taken place as it digests more data on inflation and other facets of the economy. So in other words, if we get worse data regarding inflation or unemployment, for example, that could cause the yield to increase and also cause mortgage rates to increase further. However, if we see status quo where a lot of changes don't take place and we don't see a lot of unexpected changes that hit the market, then mortgage rates could stabilize this year. So in regards to mortgage rates, have a look at this. This is according to Freddie Mac. These are the changes in mortgage rates over the past 1 year. So the data we have from Freddie Mac is through 4/14, when the average was around 5% for a 30-year fixed rate mortgage, about 4.17 for a 5-year mortgage, and 3.69% for a 5/1 ARM. Look at the 30-year fixed rate mortgage though. So basically 1 year ago, it was about 3%. It more or less was flat through December, but really through the end of December through right now, mortgage rates have been spiking greatly. They started about 3% about 4 months ago. Now we're over 5%. Meanwhile, the yield on the 10-year US Treasury note is at 2.857% as of the end of today, which is the 18th, the highest levels we've seen since basically late 2018. In regards to mortgage rates, here's what the National Association of Realtors had to say regarding these rates increasing greatly so far this year. They say mortgage rates surged to 5% for the first time in over a decade since February 2011. By the way, they are looking at rates on a weekly basis according to Freddie Mac. I personally look at the Mortgage News Daily to look at average rates on a daily basis. So the stats here can be a little bit different than the Mortgage News Daily. So anyways, elevated inflation continues to push up mortgage rates. While the Fed's next meeting is in early May, that's coming up here, inflation will determine how aggressive the Fed's next steps will be. There's a lot of talk about how the Fed's going to be increasing the federal funds rate in their next meeting. A lot of people think they're going to be increasing it by 50 basis points. I personally think they may increase it by only 25 basis points. So we'll have to see what they do in their next meeting here in a few weeks. It says since the beginning of the year, mortgage rates rose by 1.8 percentage points. This change added about $400 to the monthly mortgage payment for a medium price house. This means that potential buyers need to spend more of their budget on housing to buy the typical house. Meanwhile, inflation is at 40-year highs, and that's causing people's budgets in order to buy a house to erode, of course. It says in the meantime, although inflation rose to 8.6%, wages decreased 2.7% in March compared to 1 year ago. Inflation overshadowed all wage gains. Real wages on a year-over-year basis have dropped consecutively since April 2021. Comparing inflation with real wage growth since 2008, this is the first time that inflation has risen so much faster than wages. This, of course, causes a housing affordability issue, which I talk about all the time on the channel. You can't have home prices increase 20% every single year with having wage growth of less than 5%, right? Anyways, it says with rising borrowing costs, expect about 16 million households to be priced out of this market this year. As a result, the National Association of Realtors forecasts home sales activity to drop about 10% in 2022. Okay, changing gears slightly, let me give you an update regarding mortgage loan forbearances. I used to make a video about this every single week because there were so many different changes every single week, basically earlier on during this pandemic. And the Mortgage Bankers Association used to release a report every single week, as well as Black Knight as well. I report that to you guys. But now it's on a monthly basis from the Mortgage Bankers Association. So here's our latest report that was actually just published today, the 18th of April. So as of March 31st, 2020, we only have 1.05% of all mortgages are in forbearance. This number used to be way, way higher, so the numbers have been decreasing greatly. So right now, according to MBA's estimate, there's only 525,000 homeowners who are in forbearance plans, and that's far less than we previously had. I'm going to be sharing some data regarding that here in a little bit. According to the MBA's Marina Walsh, she said the following: the share of loans in forbearance continues to dwindle and is just 5 basis points shy of hitting 1%, or 500,000 homeowners who are currently in forbearance, after peaking at 4.3 million borrowers in June 2020. So we had over 4 million people in forbearance in June 2020. Now we have 525,000, according to the Mortgage Bankers Association. It has been a remarkable recovery for many homeowners in less than 2 years. So here's a really good graphic I want to share with you guys. Since June 2020, we had 8% of all loans that were actually in forbearance at that time, actually just over 8%. This is the percent of servicers' portfolio volume that were in forbearance. In other words, the share of loans in forbearance out of all the mortgages out there, more or less. So just over 8% in June 2020. That has been decreasing greatly, and now we're only at 1.05% of all loans out there in the US. So here's something I found to be very interesting. I definitely want to point this out to you guys. It's really important to get an idea about, what have people done when they ended their forbearance plans. So it says of the cumulative forbearance exits for the period from June 1st, 2020 through March 31st, 2022, at the time of the forbearance exit, 29.2% resulted in a loan deferral or a partial claim. So basically what they're saying is that out of all the people who have ended their forbearances for this time period, 29.2% opted to do a loan deferral or a partial claim. In my opinion, this is the best scenario for people who have ended their forbearance plans, because in this scenario, you take all your missed mortgage payments and just add it to the back end of the loan. So in other words, it just gets added to your loan balance, but your payment remains exactly the same before you enter into forbearance. In addition, just under 19% represented borrowers who continued to make their monthly mortgage payments during their forbearance period, even though they didn't have to. So about 19% just continued to make their mortgage payments on time, even though they were in forbearance. By the way, forbearance allows you to stop paying your mortgages. In addition, 17.1% did not make all their monthly payments and exited forbearance without a loss mitigation plan in place yet. So in other words, these people who have exited the forbearance plans, they haven't contacted their loan servicer to enter into a loan deferral, a partial claim, a loan modification, et cetera, et cetera. So it's going to be really interesting to see what happens with these 17% who have decided not to enter into a loss mitigation plan. Will these become foreclosures? Time will tell. I'll definitely keep you posted. Additionally, 15.4% resulted in loan modification or trial loan modification. This basically means that they're going to be entering into an agreement with a loan servicer and their interest rate and or their payment terms get extended. So in other words, their interest rate gets decreased or their terms get extended or even both. So the result is that their payment or their monthly payment is actually less than what it was before they entered into a forbearance. That's a loan modification. 11.4% resulted in reinstatements in which all past due amounts were paid back when they exited forbearance. That's basically a one-time lump sum payment. 6.7% resulted in loans paid off either through a refi or selling their houses. So earlier on to this pandemic, when people were saying, oh, forbearances are going to cause a housing market crash, a lot of people are going to be selling their houses. The data does not support that. 6.7% either refied or sold their houses. We're not seeing any big increases in housing inventory when people exited forbearance. And the remaining 1.3% resulted in repayment plans, short sales, deeds in lieu of foreclosures, or other reasons. Meanwhile, the total share that are actually delinquent still remains very, very low, at less than 5%. So it says here total loans serviced that were current, meaning not delinquent and not in foreclosure, as a percent of servicing volume rose to 95.4% in March 2022. So the vast majority are still current on their mortgages, even though they have exited forbearance, which is obviously a good sign. The 5 states with the highest share of loans that were current as a percent of servicing volume were Idaho, Washington, Colorado, Utah, and Oregon. In contrast, the states that had the lowest share of loans that are current, meaning the highest amount of loans that are delinquent, were Louisiana, Mississippi, New York, West Virginia, and Oklahoma. On top of this, total completed loan workouts from 2020 and onward, which would include repayment plans, loan deferrals, partial claims, and loan mods that were current as a percent of total completed workouts, rose to 83.67% last month from 82.26%. So out of all the people who have entered into a loss mitigation plan, about 83.67% are current on those plans. And obviously seeing that this number has been increasing, at least compared to last month, is obviously a positive sign with our housing market here. So comment below with your biggest takeaways from today's video. Also, if you got any value out of this video whatsoever, then please hit the like button. Also, check out that link below if you want a real estate agent referral in your neck of the woods. Hope you have an awesome day. Look forward to seeing you on the next video.